If you think you haven't put enough aside to retire, you're not alone. 50% of all workers in the UK aged 40 to 64 don't expect to have enough savings to retire. But what if I told you that you can not only make up for your lack of savings, you could even end up retiring early? Well, in this video, I'll give you a simple 3-step system to help you do just that. I'll also show you how you can boost your savings with free money. And I'm not just talking about tax relief on pensions. I'll also explain one critical factor which can make or break your retirement. So you need to get this right in order to guarantee a successful outcome. Guys, I'm Chris Bourne, and for the last 20 years I've been helping people achieve tax-efficient financial independence through financial planning. And this channel is where I share my knowledge with you to help you do the same. Now, before we start investing any money, there are some things we need to do first, but doing them in the correct order is important. As a wise man once said, a goal without a plan is just a dream. If the foundations of any building are made correctly, it's going to stand for many years. If not, it'll fall down. And it's exactly the same with your retirement. That's why step 1 in this system is the foundations. To start, you need to get your house in order. And the first part of that is looking at the interest you're paying to somebody else versus interest being paid to you. To give you an example, if you have a credit card, the interest rates you pay for borrowing money can be in the region of 18 to 25% a year, sometimes more. Whereas if you invested money in the stock market, average long-term returns have been more like 7 to 10% a year. If you imagine you've got £10,000 on a credit card and you're paying 20% interest, these red chips represent what that will cost you in a year. If we say you've also got £10,000 invested in the stock market and that has a really good year and grows by 10%, these blue chips represent what that will earn you in a year. Once you've taken away what you've earned from what you've paid, you're still left with this much cost. Whereas if you just paid £10,000 off your credit card in the first place and didn't invest, you'd have no cost, and you'd therefore be £1,000 better off. So getting rid of high interest things like credit cards, overdrafts and personal loans first is super important. But getting rid of debt isn't the only thing to get your house in order. One of my clients recently decided to combine a number of his pension plans together with a new provider. After we'd set it all up, he said, "Chris, I've just logged in and it all looks good, but what's this money over here? I don't understand why it's separate." I said, "Well, I can't see it, so it sounds like you've got an additional pension that you didn't know about. Maybe just check with the provider yourself." And sure enough, it was a pot from a former employer that he didn't know was there. It wasn't that he'd forgotten working there, it's just that his pension benefits were split in two. One part went to a new plan that he was aware of, but he didn't realise that this other part had gone elsewhere. The pension provider only had his old student address, and because they couldn't trace him, he just went down as untraceable. Now, through blind luck, it just so happened that the provider I recommended was the same company this pension was with, and all his policies were then tied together with his national insurance number. So when he logged in, there was an extra 50 grand there that he had no idea about. Naturally, he was over the moon, and he bought me a very, very nice case of red wine to celebrate the find. That's why you should always double check. There's around 3 million unclaimed pension policies in the UK, adding up to £26.6 billion. Some of that might be yours, so it's worth having a look. Now, I can't promise that you're going to find 50 grand, but there are places you can check. There's a tracing service on the gov.uk site, or the Association of British Insurers may be able to help, both of which would be free to use. You could also pay a private tracing service, but I'd probably only do that if you're very sure there's something for them to find, you just can't trace it yourself. Some old pension plans may be defined benefit schemes, which means they'll provide a guaranteed amount of income to you. And these can be very valuable because they'll give you a head start in retirement. Others, like my clients, will be defined contribution schemes, which are just pots of money available to withdraw. So that's pensions, but we don't just check those. So what other assets do you have? Have you got cash savings, like bank accounts, ISAs, premium bonds, old insurance policies that have a cash-in value? Will you receive an inheritance? How about equity in your house? If so, these are all things that can form part of a retirement plan for the future. By the time you've gone through this process, you might realise that you're not starting from zero after all. So now that you've built your solid foundations and got your house in order, you've got to work out what you need. But I think it's often too easy to say that. A lot of people will tell you to simply set a target for how much income you want in a year, and then work out how much you need to invest every year to build up a pot that will eventually produce that income. But we need to break that down into much smaller steps. So where do we start? Well, the simplest thing to do is to get out a piece of paper or open a spreadsheet and list in one column all the things you currently spend money on a regular basis. And by the way, if you're married or in a long-term partnership, it's best to do this together. Write down the following. What are your bills and regular direct debits? What do you spend on fueling your cars, on food, on going out, on everything? Once you've got that, write down in another column whether those costs will still be there when you retire as well, and whether you think they'll be more or less than they are now. Forget inflation and how much things might cost in the future. Just think in today's terms for now. For example, if you've got a mortgage and that will be paid off by the time you retire, that can be removed from the new column. If you have a long commute to work, your fuel spending might be less in future. If you think that you'll want to spend a bit more on eating out, put more. Once you're done, you'll have your estimated monthly living costs for retirement. Times that by 12 to give you an annual figure, and then add in things that you might only pay for once or twice a year. Holidays, for example. What you'll then have is your very own retirement expenditure target. Now, just by having a target to aim at, you're probably already ahead of the majority of people. But working out what you need doesn't just stop there. You've also got to work out how much to put aside regularly in order to meet that target. Fortunately, there are calculators designed to help you do just this. There's a fantastic free one at honestmath.com. Rather than go into too much detail here though, I've created a separate video to run through that site and compare it with a more comprehensive system. The one I use with all of my clients, which is called Voyant. It's only a short video, but it will highlight the main differences and allow you to choose what's best for you. I'll link it in the description below. But what if you're then saying,
Chris, I've done all this work, but I can't afford what I'm being told I need to invest.
Well, I'll explain exactly how a client of mine got around that shortly. But first, there are practical things you can do to boost how much you can invest without needing to get a pay rise. This is where you need to take action. Sorry for stating the obvious, but nothing will happen if you don't start. And by the way, if you are looking to start investing, I've listed some of my favourite investment platforms in the description below. But I said at the beginning that I'd tell you how you can boost your retirement savings with free money. And that free money wouldn't just be tax relief. But in case you're not aware of how tax relief works, it's like a bonus that's added on top of everything you pay into a pension. You see, when you're paid salary, tax is usually taken from it. So when you get £100, you've technically earned £125. So imagine this is £125. But the government took 20% of it as tax. When you pay that remaining £100 back into a pension, the £25 that was taken is added back on top. And that's what tax relief is. Some people pay more than 20% tax depending on how much they earn, and they can claim that additional tax back when paying into pensions as well. There's a chance this system could be reviewed by the new Labour government though, so we may see some changes to it soon. There are other ways to make free money though, and one is through your employer. Many employers will match your pension contributions up to a certain amount, so find out what their maximum contribution is and take full advantage of that. A lesser known way is through what's called salary sacrifice. I know, it sounds weird to sacrifice money to get free money, but that's not quite what it means. You see, when your employer pays your salary, you both have to pay national insurance on it. It's kind of like another tax, but you only pay it if that money is given to you as salary. By sacrificing a little bit of that salary and having your employer put it straight into your pension scheme rather than your bank account, you both pay less national insurance, making it beneficial for both of you. Now, some employers give the money they save on paying less national insurance to their employees as an extra pension contribution. Other employers don't even think about this though. So it's good to ask, will you pay your national insurance saving into my pension if I salary sacrifice? It doesn't cost them anything extra, and worst case scenario, they say no and nothing changes. The other thing about salary sacrifice is that you pay less income tax too. So if your employer will share their national insurance saving with you, Even a basic rate taxpayer could see a 58% increase on their pension contribution. That's before the money's even been invested. And that's all shown on the example on screen now. So feel free to pause and absorb that. Another way of making free money is getting cash back on the things you buy. More banks are offering cashback current accounts now, and some credit cards do too. As long as you pay your credit cards off in full every month and don't pay any interest, this can be a great way to make some free money, but you have to make sure that they're paid off in full. Also, using cashback sites like Top Cashback can help too. It's all money that can be invested and help your plan, but you do have to be careful. It might be free money, but don't just use cashback as a justification to spend more than you were going to. That won't help in the long run. Now, I said earlier that you might do all of this and still be in a position where you just haven't got enough money available to invest to meet your goal. You might at that point think, what's the point? It's obviously too late for me. Well, I had a client years ago who struggled with this very thing. To start off with, like a lot of people, he always had something better to spend money on than a pension. Then one day he decided to speak to a pension advisor at work, and the advisor went through everything and told him that all he needed to do was put aside X thousand pounds a month and he'd reach his target by 60. No problem. Except there was a problem. It was way more than he could afford. So, disappointed, he went back to work and carried on saving nothing. Now, when I met him, he was helping his mom sort out his dad's pensions, who'd recently passed away. And he told me all of this, still thinking he'd never be able to retire. But together, we completely changed his outlook and his future with 3 simple words. Define retirement success. You see, he was focused on full and complete retirement, on an income that broadly matched what he was currently earning. And from where he was standing, that looked completely unrealistic. If you've ever seen the domino effect, where knocking over a small domino can set off a chain of events that eventually knocks a huge domino to the ground, it was like him trying to push the biggest domino over first. So I said, forget about complete retirement at 60 for the time being. What if you're able to work 1 day a week less at that age? What if your weekends were 3 days instead of 2? Would that be a positive change? And he agreed that it would. So he made that the target instead and put a plan in place to achieve it. One that felt much more realistic, but would still provide a positive, successful outcome when reached. So that is the critical factor I mentioned at the start, how you frame retirement success. Rather than trying to move a massive mountain, set goals that, with the right effort and focus, are achievable. Realistic goals are more likely to get you started and keep you on track, and starting will guarantee that you'll be more successful than if you never start at all. So now you know how you can achieve retirement success from any current starting point. But as mentioned earlier, finding the right tools to work out how to reach your target is super important, which is exactly why I made this video on screen now for you. I'll see you there.